All right. Well, it is 12:01, so we've given people a few extra seconds to get signed in, but I think we're going to get started in the interest of everyone's time. My name is Becky McDicken, and I'm with the Pennsylvania Department of Banking and Securities. And if you are here for an insurance webinar, you're in the right place. But first, just a little bit of housekeeping. This webinar series is being brought to you because the Pennsylvania State Treasury Department received a grant, and we have been helping with this. It was awarded to us last September, and we're coming up on the last of the year, although these webinars are going to continue past the grants. The grant was administered by the National Association of State Treasurers Foundation, the Center for State and Local Government Excellence, and the International Public Management Association for Human Resources. There was also a generous donation from the Wells Fargo Foundation, so we thank them. Next slide. You should have received a postcard talking about the financial wellness initiative that is going on in the Commonwealth of Pennsylvania. This was the back of the postcard. The front had a piggy bank, but these have some steps laid out for you and how you can begin your financial wellness journey or pick it up at whatever phase you're in. So it's got some of our information on there, and make sure you find that in your stack of junk mail somewhere. Next slide. We have a couple of more upcoming videos. Obviously, today is the insurance products, the second of those two. We are actually going to be doing one in October on the child tax credit advance payments, and we do not have that listed, but I believe it is October 14th, and that is my fault that we didn't get that into the slide deck, but we will be sending out information. It should be in the employee bulletin board. October 14th, the child tax credit and the advance payments. We have a guest speaker on that topic, and then in November, we have completing the FAFSA form, which for anyone with children nearing college or in college, you'll know what that means. That will be presented by FIA, the Pennsylvania Higher Education Assistance Agency. So watch the EBB and then check out the new Employee Resource Center through OA and the financial wellness page. The link is on your slide deck as we speak. So be sure to check out the newly revised page. It is fantastic with a lot of resources. With that, I am going to turn things over to our speaker after a brief introduction. Dave Buono has been serving the insurance industry since 1999. This Penn State graduate began working with the insurance department in 2015 as the department's consumer liaison, which is how I met him, and is currently the acting deputy insurance commissioner of market regulation. In this role, Dave ensures that the department is reaching consumers and provides assistance to those navigating the complex insurance structure. He supports the department's initiatives to keep the state's insurance market competitive and focuses on helping consumers learn and understand their rights and responsibilities, what insurance product options are available to them, and provide a place for consumers to get answers to their questions. So with that, I am going to close my mouth and turn things over to Dave Buono. Thanks, Dave.
Hey, thank you so much for the great introduction, Becky, and welcome to our program today. Today we will be talking about life insurance and annuities. So let's first start talking about life insurance. And, before you can begin any kind of learnings, I always think you have to learn about the history of a product. So here's a quiz to start us off. When was life insurance born? Don't worry, I know everybody can answer it, so I'm going to answer for you. It was about 100 BC with the ancient Romans. They formed a burial club because they felt it important for all to be given a proper burial. So what year did the sale of life insurance start in the United States? 1759. The Presbyterian Synods of Philadelphia and New York City created the Corporation for Relief of Poor and Distressed Widows and Children of Presbyterian Ministers. So something really important to know about life insurance is insurable interest. So in Pennsylvania, only an individual with insurable interest can obtain a life insurance policy on another. Insurable interest means, in this case, a person related by blood or law, and interest engendered by love and affection, and in the case of other persons, a lawful economic interest in having the life of the insured continue, as distinguished from an interest which would arise only by the death of the insured. So why would insurable interest be important? It's important because of people like these six fellows. So I'll tell you a little story about a man by the name of Joseph Raber. He was poor, and he was a mountain man, and he survived by doing occasional jobs and receiving handouts from neighbors. He was 59 years old when he died. The six men in Lebanon County bought insurance policies on the life of Mr. Raber. They were sure, because of him being poor and how he was surviving, that he would die soon. And then when he died, they would be able to take care of all their financial problems. Well, Mr. Raber wasn't dying fast enough for these gentlemen, and the premiums for these policies were too much money for them to continue paying. So instead of waiting for Mr. Raber to die, they took matters into their own hands. Their plot was common knowledge in Lebanon County, and it was not long before all six were arrested for murder. The conspirators had a number of common characteristics. All six men were illiterate. All six men were living in poverty. All six men were of low moral character. But the trait that covered the public's imagination the most was all six men had blue eyes, and they became known as the Blue-Eyed Six. Another reason why insurable interest is important is because of this gentleman. He is a serial killer by the name of H.H. Holmes. It's rumored when Holmes was in medical school, he would steal cadavers from a lab, disfigure them, and said they died in an accident trying to collect on life insurance. He also allegedly became the beneficiary on policies of several women who worked with him, who all died shortly after the policy started. The insurance law of 1921 in PA made insurable interest key to the insurance policy. So, true or false quiz. I can obtain a life insurance policy on you. That's false. I wouldn't have an insurable interest to have that life insurance policy. So today we're going to talk about life insurance, but we're going to keep it at a lower level. We'll call it 101 because there's a lot to talk about with life insurance, but I want to keep it short and sweet to start. So when thinking about life insurance, you should know there are two main types, term and permanent. A term life insurance policy pays if the insured dies during the term of the policy. Unlike term insurance, all permanent policies remain in place as long as the premium is paid. They also have a cash value component that increases over time and allows the owner to borrow against that cash value. There are four main types of permanent life insurance. This presentation will focus on the basic whole life policy. So what are the four types of permanent life insurance? Whole life, which offers a fixed premium for a certain duration or for the life of the policy, guaranteed annual cash value growth, and has a guaranteed death benefit. It does not provide investment and flexibility, and once established, you're not allowed to change the policy coverage. There's universal life. That allows the policyholder to determine the amount and timing of the premium payments within certain limits and to adjust coverage levels as needs changed. There's no investment flexibility. The cash value growth is based on current interest rate and current mortality rate, and sometimes structured as term insurance. There's a variable universal life insurance policy, and that's a combination of variable and universal life insurance. It offers the most flexibility compared to the other permanent life insurance options, with the ability to vary premium payments, in investments, and coverage amounts. It allows investment in a variety of market products chosen by the policyholder and may allow policyholders to make tax-free transfers among investments. It also exposes the policyholder to greater market risk than a whole or universal life policy. Index universal life insurance allows the policyholder to determine the amount and timing of premium payments within certain limits and to adjust coverage levels as needs change. It includes guaranteed annual cash value growth, but no investment flexibility, and investment gains are based on index funds. There's more to think about than death benefit when selecting life insurance. If you choose permanent life insurance, be sure to consult a licensed investment or tax advisor for guidance on which policy best fits your risk tolerance and investment objectives. If a variable life question, you should speak to an agent because they have worked that out in their systems. So, what affects life insurance premiums? Well, that would be the age you purchase your policy. The older you are, the more expensive the premiums. Your overall health. Life insurance companies typically ask you about your medical history, request access to medical records, and even obtain blood and urine samples for testing. Pre-existing or chronic health problems such as diabetes, heart disease, cancer, or sexually transmitted diseases may prevent you from getting life insurance or place you in a high risk pool at a greater cost. Poor habits such as smoking and excessive drinking. Be aware that insurance companies may look back and consider these behaviors. Engaging in dangerous hobbies such as skydiving, rock climbing, skiing. Your driving record in terms of accidents, DWI, DUI citations, claims, and tickets. The better your driving record, the better the rate you'll receive for your life insurance. Your geographic area. Life insurance companies have access to regional data that document mortality rates and life expectancy, and they use that data to calculate the rates they offer. Now, some of these factors are in your control. Others are a function of your genetics or occupation or location. Either way, it's important for you to be educated on these issues so that you can make the best insurance decisions that fit your life. So why consider life insurance? Well, several reasons for the purchase of life insurance. You may need to replace income that would be lost with the death of a wage earner. You may want to make sure your dependents do not incur significant debt when you die. Life insurance may allow them to keep assets versus selling them to pay outstanding bills or taxes. You should consider the following factors when purchasing life insurance. Medical expenses previous to death, burial costs, estate taxes. The support while remaining family members try to secure employment. Continued monthly bills and expenses, daycare costs, college tuition, and retirement. So, how much life insurance do you need? Ask yourself the following questions. How much family income do I provide? If I were to die, how would my survivors, especially my children, get by? Does anyone else depend on me financially, such as a parent, a grandparent, a brother or sister? Do I have children for whom I would like to set aside money to finish their education in the event of my death? How will my family pay final expenses and repay debts after my death? Do I have family members or organizations to whom I would like to leave money? Will there be estate taxes to pay after my death? How will inflation affect future needs? Now, some insurance experts suggest that you purchase 5 to 8 times your current income. However, it is better to go through those above questions to figure out a more accurate amount. So here are some tips for buying life insurance. Make sure you feel confident in the insurance agent and the company. Decide how much you need, for how long, and what you can afford to pay. Learn what kinds of policies will provide you need, and pick the best one, and that's best for you. Do not sign an application until you review it carefully, just to be sure the answers are complete and accurate. Do not leave blank information, as someone could fill the information in after you sign it. Put an NA or a line through it to avoid any kind of fraud or errors in the application. Do not buy life insurance unless you intend to stick with your plan. The policy may have surrender charges. And when you buy a policy, make the check payable to the company, not the agent. All right, so that is the basics of Life Insurance 101. And now we're going to talk a little bit about something called annuities. Of course, we have to have a history. So a quiz to start. When was the first annuity born? Well, they could be dated back to the Roman Empire. The first mortality table created for lifetime stipends, which were made once per year in exchange for an initial lump sum payment. When did annuities come to America? In 1759, just like the life insurance that we had learned about earlier, they were introduced here in Pennsylvania. They were offered to church pastors. In 1776, there was a lifetime income payments for soldiers and their families. That was the National Pension Program for soldiers, which was passed actually before the Declaration of Independence. In 1812, it was the first time an annuity was offered to the public, and that was offered by the Pennsylvania Company for the granting of annuities. And in 1905, the Teacher Pension Fund, the Teachers Insurance Annuity Association, was founded. Now, who founded that Teachers Fund? It was Andrew Carnegie. So, of course, we have to have a quiz. In which state was the first annuity introduced? Right here in the great Commonwealth of PA. So let's talk about annuities. So what is an annuity? Well, first and foremost, it's an insurance product. A company pays you an income at your regular intervals during the payout phase. The payout phase, that's the period of time after the accumulation phase where payments are made. So there's an accumulation phase where you're putting money in, payouts when you're getting paid. Annuities can pay an income guaranteed as long as you live. And many people buy annuities to help manage their income in retirement. Now, there's some important things to know about annuities. Things like surrender charges. A surrender charge is a fee you pay if you cancel your policy before the stated period. We'll talk about that a little bit more later. Now, there are different types of annuities. There's a fixed, a variable, and an equity indexed annuity. Now, a fixed annuity, your money is your money minus any applicable charges, earns interest at rates specified in your contract. A variable annuity, the insurance company invests your money minus any applicable charges into a separate account based upon the amount of risk you want to take. The money can be invested in stocks, bonds, or other investments. Since variable annuities have an investment component, they must be registered with the Securities and Exchange Commission and may only be sold by individuals licensed to sell the securities as well as annuities. An equity indexed annuity is in an equity indexed annuity, the money earns interest based on changes in an index. The insurance company uses a formula to determine how to change in the index, and that affects the amount of interest to add to your annuity at the end of each index term. Now, an index is a statistical measure of changes in stock. Some indexes are measures of how the overall financial market performs, like the Standard & Poor's 500. Other indexes measure how a specific financial market performs, like NASDAQ, during a term. So the company guarantees that the accumulation value will not be less than an amount set in the contract. The equity indexed annuity may also be referred to as a fixed indexed annuity or an indexed annuity where the latter terms also include alternative or innovative indexes. So when do annuity payments start? An annuity is either an immediate annuity or deferred annuity, depending on when the annuity payments begin. Immediate annuities generally are purchased by people of retirement age. You'll begin to receive payments no later than 1 year after you pay the premium. For example, if the annuity payment period is monthly, the first annuity payment will be made 1 month after issuance of the contract. An immediate annuity is purchased with a single premium payment. Deferred annuities are purchased by people who want to accumulate money during their working years so they can receive periodic payments in the future, or who just want to save money for future use. A deferred annuity may be either a single premium contract or a contract with premium payments accepted for a limited period of time, or a contract with flexible premium payments. You do not continue premium payments as you originally planned. If you do not continue premium payments as you originally planned, you will receive reduced annuity benefits. For more information about deferred annuities, you can always visit the National Association of Insurance Commissioners, which is the NAIC, at www.naic.org and type Deferred Annuities Guide in their search engine. So how long do annuity benefits continue? During the accumulation phase, interest and/or earnings will be credited to the accumulation value. No taxes are owed on the credited interest until annuity payments begin. The length of time during which annuity benefits are paid depends on the settlement option selected. You may select payment for a fixed period of time, such as 20 years, or for as long as the annuitant is living. So where can you buy an annuity? To buy an annuity, talk to an agent who's licensed to sell annuities in Pennsylvania. If you ever want to find out if an agent is licensed in Pennsylvania, you can visit our website at insurance.pa.gov and you can search by the agent's name. You can shop around and compare the various annuity products and insurance companies. And always consult insurance company rating services such as AM Best or Moody's or Standard & Poor's. All right, so what I want to talk about right now are some educational information that we've created, such as the do's and don'ts of annuities and Annuities Guide and some things about some new laws that have been passed. So, Pennsylvania and annuities. We're going to talk about what we've seen here in PA, the new law, our education materials, and the partnerships that we have. So, here's some examples of things that we've seen, and I want you all to be careful of. Something called twisting and churning. Now, churning and twisting is the improper activity of an agent replacing one policy with another policy issued by the same or a different company through misrepresentation that new policy is good for you when it may not be. Such activity is actually done to generate new business commissions that are substantially higher than renewal policies. So they get a higher commission because of it being a new policy. The transactions of this type are generally not in the best interest of the policyholder. Now, churning, that's in the same company. So that's the agent churning within the same company a new policy. Twisting, that's when it's a different company. Now, there are times that it makes sense to change your annuity. So I don't want you thinking every time you change it's a bad thing. But the thing I want you thinking about is it should be in your best interest, not the agent's. So here are a couple examples that we saw in regards to churning and twisting. We had a 78-year-old and her 80-year-old husband. Shortly before their annuities matured, the agent convinced them to replace that annuity with another annuity. The annuity tied up their money for several more years. And in replacing their annuities, the couple had to pay $19,000 in surrender charges. Now, those surrender charges are what they paid because they closed out their annuity sooner than what they should have. This was not in the best interest of the consumer at all. We've also seen suitability opportunities. There was a 73-year-old that was approached after a free lunch Understand, if you go to a free lunch, there's no obligation to buy anything. Eat the food. You don't have to buy something. Now, this person was to provide $100,000 to purchase an annuity. Now, when we looked into it, to receive the benefits of the annuity, she would have had to live until at least her 119th birthday. Once again, not suitable for this consumer. And we're talking about this education now because we want to make sure that you know ahead of time versus after the bad behavior occurs. Now, to try to combat some of these opportunities that we've seen, there was a bipartisan law that passed not too many years ago that really put the focus on the appropriateness or the suitability of an annuity. So as you'll see here, under the new law, things like age and annual income, financial situations, needs, experience, and objectives. This is that its intended use of the annuity and time frame of using the money, liquidity needs, and the liquid net worth. These are things that agents need to take into consideration now before selling you that new annuity. There's also new training that goes along with that the agents need to go through. And we're doing our best to try to educate folks about churning and twisting and suitability. So right now, another piece of information we're going to talk about is our do's and don'ts of annuities. So read the materials. If you don't understand something, find someone you trust and ask. Do understand that money put in an annuity is locked up for a period of time. Annuities are not for short-term goals. Hey, if you take money early, there are surrender charges. Do ask about them. Do pay attention to optional features offered with annuities and get information about those additional fees associated with those features. Do use the free look period. Read and understand the terms of the contract. If they are not favorable to you, you can cancel and receive your money back. Don't ever be pressured into thinking you need to buy an annuity today or right now. Don't feel obligated to buy because someone gave you a free lunch, a free dinner, or a gift. Don't make your check out to the agent or producer, only to the company issuing the annuity. Don't accept verbal assurances. Always verify policy terms in writing. Don't work with an agent unable or unwilling to provide credentials. Now, the one thing that I want to make sure you all know is because I'm sure some of you might be on the line right now thinking, oh my gosh, there's some shady people out there. You know what? It's the minority. We have over 200,000 producers in the Commonwealth, and they are fantastic people that are doing great work and are ready to help you. So of course there are always a couple bad eggs in there, and we're doing everything that we can to catch those bad eggs. But we just want to make sure that you have the important information so that you can make the right decisions for you. Now, the Pennsylvania Insurance Department is here to help. We do not do only annuities and life insurance. We are regulators for health, for auto, homeowners, renters, life, annuities. Pretty much any kind of insurance you can think of, we're looking over. One of the great things about the insurance department as well is if you have an issue with a claim, whether it be health or whether it would be auto or home or renters, you can reach out to us. You can visit our page at insurance.pa.gov and you can actually file a complaint, and we will look at that complaint and see how we can help. You can also call our Consumer Services Bureau at 877-881-6388. I would like to thank you all very much for allowing the insurance department to be part of this meeting today. We are absolutely happy to be here and assist in any way that we can. And we're happy to talk about any insurance needs that you have or questions that you have. Once again, we are regulators. We do not sell insurance or anything like that. We license folks and we make sure that folks are doing the right things so that when you're in your time of need, they're there to help you. So with that, Becky, if you're still with us, I'm going to hand it back to you. Is that okay?
I am still with you, and actually we have a question. Someone has asked, if no one really relies on you for support, should you have life insurance? So what would your response to someone who there's no one relying on them, but
Well, you know, when you have life insurance, you also have to take into consideration of, when you pass, you need to be buried, and folks need to take care of those things. So even if you're choosing not to have a high dollar life insurance policy or anything of that nature, it may be worth talking to an agent just to see how much of a policy would be worth it to you. So while you may not have that person you want to give the money to, you may have expenses that you want to make sure that someone isn't given because you didn't have a life insurance policy. I hope that answers the question.
I hope so too. If there's a follow-up, we will know. Any other questions from our audience this afternoon? So far, nothing.
All right. Well,
Um,
Becky, if
oh,
folks think of questions after the fact, they can always reach out to me as well. I'm always happy to answer questions. And what were you going to say?
okay.
I cut you off. I'm
Well,
sorry.
and I was going to say we usually send out a survey, and if people have follow-up questions through that, they certainly can ask there as well, and we can feed them to you, Dave. But there's a survey that usually comes out, and of course, we want feedback. We want if you have ideas for other topics, things of that nature, we are happy to accept those suggestions as well. So please do give us that feedback. I know that today we focused on life insurance and then annuities. So there may be other insurance questions you were hoping were going to be covered today. Let us know that in the survey as well. So we can always have Dave back somewhere down the road, or one of his fabulous colleagues, whatever. And if there are no other questions, I guess we're going to sign off for now. But just remember, we are having a bonus session in October on the child tax credit and the advance payments on October 14th at noon. Watch the employee bulletin board for that. And other than that, anybody else have any comments or questions? Going once,
Yeah.
going twice. Go ahead.
And Becky, we'd be happy to come back and talk about any other insurance as well, homeowners, auto, flood, anything folks would like to talk about.
Okay, great. Thank you. All right. Well, I think that's it. So for now, everyone have a great rest of your day, and thanks for joining us today.
Thank you, everybody.
Thanks.